In-depth analysis of recent U.S. stock market volatility. Economic data and Federal Reserve policy. The economic outlook in the United States remains uncertain, which is a significant driver of market volatility. The Federal Reserve has been closely monitoring inflation and economic growth indicators to guide its monetary policy decisions. While there has been some economic growth, it has been uneven and mixed. For instance, the second quarter GDP growth showed signs of improvement, but inflation remains stubbornly high, particularly in core measures like the Personal Consumption Expenditures Price Index. This ambiguity in economic data complicates the Fed's policy direction. The central bank has been tightening monetary policy to combat inflation, but the effectiveness of these measures is under scrutiny. Financial conditions have remained relatively loose due to factors like excess reserves in the banking system and the expansion of the Fed's overnight reverse repo facility. As these conditions potentially tighten, it could lead to a liquidity crunch, causing increased market volatility. Election-related risks. The approaching 2024 U.S. presidential election is a critical factor contributing to market volatility. Historically, election years often see increased market uncertainty, especially when the outcome is uncertain or potentially contentious. The current political landscape, with the possibility of a rematch between former President Trump and President Biden, is particularly volatile. Investors are concerned about the policy implications of either administration, especially concerning fiscal policy, trade, and regulatory measures. The CBOE Volatility Index, often referred to as the fear gauge, has shown increased activity in contracts expiring around the election period. This indicates that traders expect significant market turbulence leading up to and following the election. The wide gap between September and October zinc futures suggests heightened concern about potential disruptions or shifts in market sentiment. Beyond domestic issues, global factors also play a role in the market's volatility. Geopolitical tensions, trade disputes, and varying economic conditions across major economies contribute to an uncertain global economic environment. For instance, supply chain disruptions continue to impact various sectors, while divergent inflation rates across countries add to the complexity of economic forecasts. Moreover, there are broader concerns about the sustainability of current asset valuations. The stock market has seen significant gains in recent years, leading some analysts to question whether these valuations are sustainable in the face of economic and political uncertainties. This skepticism can lead to increased market volatility as investors reassess their positions and seek to hedge against potential risks. Given these uncertainties, investors are advised to diversify their portfolios and consider strategies to hedge against volatility. This might include investments in real assets, investment-grade credit, or option strategies like put options on the S&P 500 or call options on the VIX. Such strategies can provide protection against downside risks while allowing for participation in potential market upswings. In conclusion, the recent volatility in the U.S. stock market results from a complex interplay of economic uncertainties, potential shifts in monetary policy, political risks associated with the upcoming election, and broader global economic concerns. Investors should remain vigilant and consider a range of strategies to navigate this uncertain environment.